In the words of Warren Buffett, the most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Our next session is titled Behavioral Biases and Pitfalls, Stories on How Investors Go Astray and How to Overcome Them. To moderate this session, we have amongst us Mr. Kalpen Parekh. A few words about him. Mr. Kalpen Parekh is the president of DSP Investment Managers Private Limited. He has over 2 decades of experience in finance and asset management. He is passionate about behavioral finance, a prolific Twitter user. He uses the medium to post messages on behavioral finance and interact with the community on the subject. So in this session, we are going to have 2 prolific Twitter users, Mr. Morgan Housel and Mr. Kalpen Parekh. Over to you, Mr. Parekh. Please welcome.
Thank you. Good afternoon, and thank you, everyone. I'll add one more line to my introduction for the next introduction. I have moderated a session of Morgan Housel. So that is how my next introduction will also get added. Quickly, Morgan Housel, partner at Collaborative Fund and former columnist at the Motley Fool and Wall Street Journal. And those were the days since which I started reading you and had a deep and profound impact on how I started looking at the world of investing. And I've tried to apply a few of these principles. I must admit here and give all the credit to you, Morgan. My company uses visiting cards which are inspired by you, and I'll show them to you later on. In fact, he's been awarded the best in business from the Society of American Business Editors and Writers, one of the most prolific writers who believes in simplicity and humility. In the last session, when Paul asked one of the questions to Mihir about how to make finance more relevant, he mentioned that all of us, in fact, most of us sitting in this room have made finance very intimidating. And I think the next session and the next speaker, Morgan, is someone who actually has tried to make finance more simpler, more connecting, more real, and more human. I can assure you his session will cure all neck pain, because most likely we will not be looking at our mobiles. We'll be looking at the screens here. He's written 4,000 articles over a span of a decade. And I believe, I quoted this yesterday, that every line that he writes almost can become a quote. And every blog of his is steeped with deep simplicity. But imagine to write 4,000 simple blogs must be so difficult. And I think that's what we'll get to learn when we hear him. I've picked up a couple of key messages from reading him over time. Personal finance is less finance but more personal. I've picked up his core message on focusing on big things and focusing on simplicity, focusing on realizing that a lot of things we don't know while we claim to behave, or we behave as if we know a lot. So it's a very humbling sort of experience when you hear him and read him. In fact, one of his most popular article, which was The Psychology of Money, has had 500,000 hits or likes. So it's a big number for someone writing in the world of finance. Lastly, he always says that one of the best or the biggest source of building wealth is time and compounding. And he says, do not interrupt it unnecessarily. I will take that advice and not interrupt the flow of thoughts in his mind, flowing from him to all of us. And hence, with that, I would like to invite you, Morgan. Over to you. Thank you.
Thanks so much. Good morning, everyone. And I say good morning because I'm jet lagged. And it's like 4 in the morning for me right now. But I'm really happy to be here. And I love coming to other countries and meeting investors from other countries, because when you meet other investors from different countries, you realize that we are all playing the same game. And we have similar emotions, and we have similar goals, but we've had vastly different experiences as investors. And what I've experienced as an investor in the United States is completely different from what you have experienced as an investor here in India. And because of that, I think there's a lot that we can learn from each other. So what I want to do is start today with the story of two investors in the United States, neither of whom knew each other, but whose paths crossed in a really interesting way a few years ago. And the first is a lady named Grace Groner. So Grace was born in 1910, just outside of Chicago, and she had kind of a hard life. She was orphaned as a child. She never married. She never had kids. She lived in a one-room house for most of her life. She worked as a secretary for her entire career. She was, by all accounts, a lovely lady, but she had kind of a hard life. And Grace Groner died in 2010. She was 100 years old. And when she died, everyone who knew her was shocked to learn that Grace left $7 million to charity. And all of her friends who knew her said, "Where did Grace, this humble secretary, get $7 million?" And they started digging through her papers, digging through her accounts, and they realized there was no secret. There was no inheritance. There was no lottery winnings. Basically, she took what little she could save from her salary as a secretary, and she invested it in the stock market, and she left it alone for 80 years. And that was it. That was her story. The second person I want to talk about today is a guy named Richard. And I'll leave his last name out. But Richard had nearly the exact opposite upbringing as Grace. He was born into a very wealthy family, went to Harvard University, got his MBA from Harvard Business School. He went to work on Wall Street in the 1980s and truly became one of the most important men in global finance. He became a vice chairman of Merrill Lynch during the 1990s bull market. He retired in his mid-40s to pursue charitable activities. He had made enough money that he was done. 2 weeks after Grace Groner died, Richard filed for personal bankruptcy. He told the bankruptcy judge that the financial crisis of 2008 completely wiped him out, so much so that his only source of money to buy food for his family was selling the furniture out of his house. And what I think is interesting about these two stories is that there's no other industry in which those stories are even possible. There's no other industry where someone with no education and no background, no experience, can vastly outperform someone with the best background, the best experience, the best education. It just doesn't happen in any other industry. It's impossible to think of Grace Groner performing open heart surgery better than a Harvard-trained cardiologist. It's just impossible. It would never happen. But it does happen in finance. It happens in investing. And what that shows, I think, is that investing is not necessarily about what you know. It's about how you behave. And behavior is very hard to teach. It's not analytical. We can't sum it up with clean formulas that can be plugged into a spreadsheet. It gives you a number. It's just kind of a soft, mushy topic. And because it's a soft topic, it often gets swept under the rug when we're learning about investing. So what do we do about that? Well, what I want to do today is share the learning method that I've seen a lot of investors use to wrap their heads around this idea of behavioral finance. I have a friend named Patrick O'Shaughnessy. He's a great investor, and he has a private book club that he shares with his friends, book recommendations, book reviews. He sent around an email to his book club about 2 years ago, and the subject line of the email was this: the best investing books of 2016. Now, the first line of the email said something very interesting. It said, quote, "Since it is more productive to read around one's field rather than in one's field, there are no investing books on this list." And this I think, is actually a very effective form of thinking. Because investing, again, it's not the study of finance. It's a study of how people behave with money. And since it's a study of behavior, it incorporates the lessons and the rules from all kinds of other fields that also study behavior, like psychology and sociology, politics and history. There's all these fields that we think of are standalone fields, but they all fit under this umbrella of how do people behave around uncertainty? How do people deal with risk and opportunity? And that's all that investing is. And so what I want to do today is share 5 stories, none of which have anything to do with investing. But all of them, I think you'll see, have a pretty clear takeaway about what we as investors can do to think about risk in a more productive way. The first story I want to talk about today is what nuclear energy teaches us about investing. The peaceful use of nuclear energy really took off in the early 1970s. And it's hard to overstate how big a deal this was at the time, because nuclear energy promised to solve one of the biggest problems of human history, which was securing abundant energy irrespective of your country's natural resources. And so most developed nations during this time were pursuing nuclear energy. One of those countries was Austria. The Austrian government came together in 1972, and they said, we're ready for nuclear energy, and they built their first nuclear power plant. This is it there. This is the Zweltendorf nuclear power plant just outside of Vienna. It cost about $1 billion to build, took several years to build, to complete. And when it was complete, it had the capacity to supply 10% of Austria's energy, which is massive for one power plant. Now, just before they turned this power plant on, there were a series of newspapers in Austria that were very against nuclear energy. One of the reasons for that is the owners of the newspaper also owned a lot of hydroelectric plants. And they began a series of newspaper articles, editorials, and these education sessions to kind of warn the Austrian people about how risky nuclear energy was. And this caused a panic in Austria. And this campaign was so effective, there were so many protests about Zweltendorf, that in 1977, Austria held a referendum that said simply, we have a nuclear power plant, do you want to turn it on? And the Austrian people voted no. And that's held through today, actually. Zweltendorf has never produced a single watt of energy. It's used as a training facility for German engineers, and it's sort of like a nuclear museum. And what's interesting about this, I think, is that at the very same time this was going on, the United States and the UK and France and Germany were all building and enthusiastically using nuclear energy plants. India was building and enthusiastically using nuclear power plants. Japan, which understood the risk of nuclear energy better than anyone else firsthand, was building and enthusiastically using nuclear power plants. And the Austrians had the same data as everyone else. They were building the same types of power plants with the same engineers, the same safety mechanisms. But while the rest of the world came together and said, it's absolutely worth the risk, Austrians came together and said, absolutely not. It's so not worth the risk that don't even turn the one on that we spent $1 billion to make. And what that shows, I think, is that when people think about risk, they don't necessarily do it in an analytical way, where you just take the data, you put it in the model, and it tells you whether it's risky or not. People do it in a cultural way. And everything that you think is risky is heavily tied to the country that you live in, the generation you were born into, the values that were instilled in you by your parents and your teachers. And all these things are not only outside of your control, but they vary wildly from person to person. And we want to think that risk is a force of nature that applies to everyone indiscriminately, and it is. But that's not how people actually think about risk in their own life. Everything that we think is risky is heavily tied to our own unique personal pasts. And that's also true in investing. This I want to show you, this is what US stocks did during your teens and 20s, your young, impressionable teens and 20s, based on what year you were born. If you were born in 1970, the stock market went up tenfold in your teens and 20s. That's after inflation. Incredible return in the United States. If you were born in 1950, the market went nowhere during your teens and 20s. So I would ask, do you think these two generations went through the rest of their life thinking the same thing about the stock market? Thinking that it had the same amount of risk embedded in it? Or thinking that it was capable of producing the same kind of results? Of course not. This stuck with them for the rest of their life. And this is also true for something like inflation. Inflation in the United States, if you were growing up during the 1970s, inflation averaged about 8% per year. If you were growing up during the 2000s, it averaged about 2% per year. And if you came of age during the 1930s, during the Great Depression, it was negative 2% per year. So again, do you think these people went through the rest of their lives thinking the same thing about inflation? We saw how this impacted people in the last decade when gold as an investment became very popular in the United States as our central bank was printing a lot of money. And what demographic do you think gold was very appealing to during that time? It wasn't my generation. We've never experienced inflation. It was my parents' generation who came of age in the 70s when inflation was very high. And they remember that pain. They remember what it felt like. They have the scar tissue from it. I was recently in Australia where they haven't had a recession in 27 years. Whereas we've had 3 recessions in the last 27 years in the United States, 2 of which were devastating and reshaped our culture. Now, I think it's possible that the Australians are complacent about the risk of future recessions. But it's equally possible that we in the United States are overly paranoid about the risk of recessions. I don't think you can say one group is smarter or better informed than another. I think all you can say is we've had vastly different experiences, and so we think about risk in a totally different way. Now, about a decade ago, a group of researchers crunched a bunch of data from historic brokerage accounts to see how does this actually impact investors in real time. And what they showed is if you grew up during the Great Depression, you were about half as likely to own stocks later in your life compared to those who grew up in the 1960s when the economy was strong. If you grew up during the 1970s when inflation was very high, you were a third as likely to invest in bonds later in your life compared to those who grew up in the 1950s when inflation was low. And if you grew up during the 1980s, you were twice as likely to buy stocks at the same point in your life compared to those who grew up in the 1970s. And their grand conclusion when they put all this together was, quote, "Our findings suggest that individual investors' willingness to bear risk depends on their personal history." Now, a few years ago, I interviewed Dr. Daniel Kahneman. Kahneman is a psychologist who won the Nobel Prize in economics for his insights in behavioral finance. And we talked about this idea that our individual past shapes how we think about risk in the future. And he had some interesting things to say. We were whispering to each other. No. Let's start that over. Okay. Hopefully it works now.
If I have problems remembering the past and I'm fooling myself, how does that shape my view of the future?
The main mistake that people make, it's not so much in remembering the past, it's in thinking about the past. Whenever something happens, and we feel we understand it, we're surprised occasionally, but by and large, the world makes a lot of sense to us. And it makes a lot of sense because when things happen, we find their causes, and it's okay. Except that if you compare our ability to explain the past with our ability to forecast the future, the difference is really quite dramatic. I mean, we explain the past with the greatest of ease, and we're really crummy at forecasting the future. Hindsight, the ability to explain the past, gives us the illusion that the world is understandable. It gives us the illusion that, the world makes sense, even when it doesn't make sense. That's a big deal in producing mistakes in many fields.
Now, later during this talk, he kind of inadvertently revealed how this applies to him personally. He mentioned at one point that he's the biggest pessimist he's ever met. He said, no one is just more pessimistic about the outlook of humanity than he is. And we said, wow, that's really fascinating. Is that because you have all this insight about behavioral biases and how our thinking goes astray? And he said, no. He said virtually everyone in his family is a pessimist. And he started talking about their background, about growing up in Nazi-occupied France, and how he learned from an early age how complicated and sometimes evil people can be. And that's obviously not an experience that I had. It's an experience that few, if anyone in this room had. But that was his life. And it shaped how he thought about risk for the rest of his life. And maybe that's an extreme example, but we all have something like that. Whenever we're thinking about risk, we all just become prisoners to our own unique personal past. And so we asked Kahneman, what can we do about this as investors? And he had 3 things to keep in mind. His first was talk to as many different people as you can, particularly people from different generations and from different countries, often like we're doing here today. When you meet people from different countries or different generations, and you talk to them about their views, what they expect, what they've dealt with, you're broadening your horizons and thinking about a broader range of outcomes that you might experience during your lifetime as an investor. His second point was talk to people who you disagree with. The confirmation bias, or only seeking information from people who are similar to you or agree with you, is very prevalent in politics. It's also very prevalent in investing. And Kahneman's point was, if you have a view about where the economy is going next, or where the stock market is going next, it is incumbent on you to be able to explain the opposing side's view as well as they can. Because very often what happens when you meet someone who disagrees with you is you automatically assume that person is not as smart as you or doesn't have as much information as you. Where very oftentimes they do. They are as smart as you and they have as much information, but they've seen a very different view of the world than you have. And by trying to put yourself in their shoes, you are again just broadening the scope of possibilities in your mind that you might experience throughout your lifetime as an investor. And his third point was talk to people who are in different emotional states than you are. Finance and different types of investing is very emotional. Whether you are a professional or an individual, if you are dealing with your career risk as a professional investor, or your retirement, your ability to send your kids to college as a personal investor, it's hard to think about those topics in an unemotional way. And Kahneman's point was, particularly for financial advisors, one of your main jobs is the ability to be able to see your client's financial state without all the emotional baggage that that person themselves brings to the table when thinking about money. So that's the first story I want to share today. The second story is what the war on cancer teaches us about investing. The war on cancer in the United States really ramped up in the early 1970s. And if you go back to this time, there was a big burst of scientific optimism. We had just landed on the moon. We'd made big strides in wiping out polio in the United States. There was just a general sense of optimism that if we put our heads together, we can solve any scientific problem, no matter how complex it is. And so the 1970s was, it's time to cure cancer. That was the big thing. The National Cancer Act was signed in 1972, and that began a big surge of scientific funding for cancer treatment and cancer research. And this is what's happened since. This is the age-adjusted cancer mortality rates over the last 30 or 40 years. And you can see that most of them are down, and they're down by a lot. And even lung cancer, which is the one that's rising for most of the time, is now declining. So the war on cancer has been very effective at saving and extending tens of millions of lives. But about 10 years ago, the director of the National Cancer Institute, his name is Harold Varmus, gave a speech at the annual meeting for the National Cancer Institute, and he said, look, despite this progress that we've made, the cancer community needed to come to terms with an inconvenient truth, which is that we have not been able to cure cancer like we once thought possible. And we might not ever cure cancer like we once thought possible. It just turned out to be a much more complex illness than we ever imagined. And if you accept that hard reality, then the cancer community needed to open up a new front in the war on cancer, and that was prevention. Because we know that about half of all cancers can be directly tied to lifestyle, mainly diet and smoking. And so if you wanted to make another leg down in these numbers and improve these numbers even more, what we needed to do was to make sure that people don't get cancer in the first place. And what's happened next over the last decade has been very interesting, which is that even though we know how important this topic of prevention is in the war on cancer, it's very difficult to get a lot of doctors to take it seriously. Very difficult to raise money for cancer prevention. Very difficult to get politicians interested in cancer prevention, especially relative to how much money you can raise and how much attention you can get for cancer research, for cancer treatment. About 5 years ago, one of the top cancer researchers in the world, named Robert Weinberg out of MIT, had some really interesting thoughts about why this is, about why it's so hard to get the cancer community interested in prevention despite knowing how important it is. And what he said was, quote, "If you don't get cancer, you are not going to die from it. That is a simple truth that we overlook because it is intellectually not very stimulating." He went on to say, quote, "Getting someone to quit smoking is a behavioral exercise. It has nothing to do with cells and molecules, and so people like me are essentially uninterested in it, in spite of the fact that getting someone to quit smoking will have vastly greater impact on cancer mortality than anything I can hope to achieve in my own lifetime." So it's interesting, right? You have one of the top cancer researchers in the world saying, I can make a bigger impact doing something else, but it's not intellectually stimulating enough for me. It's not exciting for me. And look, we don't want people like Robert Weinberg trying to help people to quit smoking. He's a molecular biologist, and he adds value in his own way. But there's this irony in the war on cancer, which is that things that are very simple, very basic, and very effective are discounted and not taken as seriously as other things that are complex, but knowingly less effective. And that's also true in investing. We know the simple formula that you need to succeed in investing markets over time. It's not very complicated. All you need to do is spend less money than you make, save the difference, buy a diverse portfolio of great companies, and be patient. That's it. That's effectively 90% of what you need to know to do well in the markets over time. But do you think this is how investing is taught in schools? I still have a finance textbook left over from college, and there is a chapter in the textbook called The Assessment of Confidence Limits of Selected Values of Complex Valued Models. That formula is in there. Look, the left side of this chart is the diet and exercise side of investing. It's very effective. We know it's effective, but it's not very exciting for people to talk about. It's not very exciting for really smart academics to do research on. The other side of this chart is the really complex, treatments for cancers. It's not that it's bad. A lot of it's very good, but we know it's less effective than the simple stuff. But since it's exciting and intellectually stimulating, that's where most of the brain power goes in the industry. This I want to show you. This is Warren Buffett's office in Omaha, Nebraska. He's worked out of this office for about 60 years. So this is the desk where he became the greatest investor of all time at. And I just want you to see how simple and basic it is. There's no TV. There's no computer. There's no ticker tape. There's no analyst screaming into his ears. It's just a desk and some books where he can read and think. There's a picture of his dad behind his shoulder. I don't know if you can see up front here. There's a bin at the top of his desk that says too hard. He comes across an investment that's too hard, he just puts it in the too hard bin and moves on. It's just as simple as you could possibly get. This is the mortgage trading desk at Lehman Brothers right before they went bankrupt. Guy has 8 monitors in front of him. What is he looking at that needs 8 monitors? Poor guy next to him only has 4 monitors. He hasn't been promoted yet to 8 monitors. But look, if you are a young person coming out of college and you're looking for an exciting career in finance, what looks better to you, this or this? Or if you are a fund manager and you want to show your clients that you are smart and you're adding value, what do you want them to see in your office, this or this? It's obvious where the attention and the intellectual horsepower in the industry goes to, even though we know the irony that these people went bankrupt and this is the greatest investor of all time. Speaking of Warren Buffett and Berkshire Hathaway, there was about a 20-year period where the average private equity fund returned about 14% per year, while Berkshire Hathaway returned about 19% per year. So this 5 percentage points of annual outperformance is what made Berkshire Hathaway and Warren Buffett the greatest investor or one of the greatest investments of all time. And there are 2,000 books on Amazon that are devoted in some way to picking apart, trying to explain how Buffett did this, where this outperformance came from. And they go into grand detail about how he sizes up management teams, how he thinks about valuation and market volatility. A lot of them are great books. But here's one thing I want you to think about. The average private equity fund is charging 2 and 20 as a fee structure. 2% of assets, 20% of profits. It's a standard fee structure. Berkshire Hathaway charges no fees whatsoever. Buffett's salary is $100,000 a year. There's nothing else attached to it. Just that one fact alone, that the average private equity fund is charging 2 and 20, and Berkshire charges nothing, just that one fact accounts for 4 percentage points of the outperformance over time. How many of those 2,000 books do you think mention this? I've never seen it mentioned anywhere. And I think the reason why that is because this explanation is too simple for people to take seriously. People don't want to believe that you can become the greatest investor of all time, and about 80% of it can be explained by something like fees, even though we know just as a matter of simple arithmetic it's true. That you can explain a lot of Buffett's success by saying he's a pretty good private equity fund manager who doesn't charge fees, and he's been going at it for 70 years. That's most of how you can explain it. But again, that explanation is way too simple for most people to take seriously. A few years ago, somebody asked Charlie Munger, who is, of course, Warren Buffett's longtime business partner, they said, kind of in a sarcastic way, they said, Mr. Munger, if what Berkshire does is so simple, why haven't more people copied it? And Munger said, quote, More investors don't copy our model because our model is too simple. Most people believe you can't be an expert if it's too simple. He went on to say, quote, how did Berkshire's track record happen? If you're an observer, you would see that Warren did most of it by sitting on his ass and reading. It's as simple as it gets. My favorite example of this is from a US economist named Harry Markowitz. Harry Markowitz won the Nobel Prize in economics in the early 1990s for his work on the efficient frontier. Very mathematically complex set of formulas that will tell you exactly how much of your assets should be in stocks versus bonds based on how much risk you want to take. This is a group of CFAs, so I don't need to explain that any further. You lost sleep over it, I all know. But about 5 years ago, the Wall Street Journal did an interview with Harry Markowitz, and they said, Dr. Markowitz, you won the Nobel Prize for the efficient frontier. How do you use this insight for your own personal investments? And Harry Markowitz said, quote, I visualized my grief if the market went way down and I was completely in it, or if it went way up and I wasn't in it. So I split my contributions 50-50 between stocks and bonds. Look, this is the guy who won the Nobel Prize for this theory, and for his own money, he didn't even use it. And what that shows, I think, is something like the efficient frontier has a lot of value in the sense that it is intellectually stimulating for very smart academics. But in the real world, what works for managing money, even their own money, are very simple rules of thumb that are often based around your own personal behavior, your own personal psychology. I think the most important investing advice that you can give anyone or take for yourself is to take a simple idea and take it seriously. There's so much evidence that we intuitively think that investment recommendations that are complicated are going to outperform those that are simple. And there's so much evidence that that idea is wrong. We often have to remind ourselves that the goal of investing is not to minimize boredom. It's to maximize returns. And look, there is no investment recommendation that is worth the paper it is written on if you or your clients are going to abandon it at the first sign of confusion. One of the things we learned in the United States after the financial crisis, when there was a crisis of trust in the United States, was that a lot of clients have a hard time distinguishing between their confusion and their advisor's intentional obfuscation. And when someone came across something that they didn't understand, they were much more likely to say, I don't know what this is, I don't get it, I don't know if I trust you anymore, so I want out. And if you want your clients to stick around for years or decades, and we all do, those clients need to understand what you're doing with their money and why you're doing it in the most simple terms possible. The third story I want to talk about today is what baby brain development teaches us about investing. I used to have a stock photo of this, and my wife said, no, you got to use something a little more personal. So, the amount of growth that takes place in a baby's brain is just extraordinary. An average baby is born with about 100 billion neurons in its brain, and each of those neurons has about 3,000 synaptic connections to other neurons that form this web of brain intelligence. It might look something like this when you're born. By 6 months old, that's increased to about 6,000 synaptic connections. It's doubled in the first 3 months. By 2 years old, it's increased to about 15,000 synaptic connections. It's just an amazing amount of growth in the first 2 years of life. But then something really interesting happens, which is that the number of synaptic connections in your brain doesn't just peak, it starts to decline, and declines pretty rapidly. By the time the average person is 4 years old, they've lost about a fifth of their synaptic connections. By the time they're 6 years old, they've lost about a third of the complexity in their brain. And this keeps going on throughout childhood and into adolescence and early adulthood. By age 20, the average person has lost almost half of the synaptic connections in their brain. Why does this happen? Well, it turns out a lot of the brain growth that goes on in your early years is not very efficient. It's wired in a very inefficient way. A lot of it is redundant. A lot of it is just wrong. There's evidence that newborn babies, especially in the first few hours of their life, can smell colors and hear sounds and smell colors or hear, they can hear colors and smell sounds because the part of their brain that is processing that information is just completely miswired. And you go through part of your life just getting rid of this bad and inefficient and miswired learning and pruning a lot of the synaptic connections in your brain. What's important about this, though, is that even though why this is going on, what's going on inside your head is loss and destruction and chaos. You're still getting smarter. A 4-year-old is much smarter than a 2-year-old. A 20-year-old is much smarter than a 4-year-old, on average. Exceptions, particularly for men. But look, this idea that you can go through loss and chaos and destruction while still growing and improving is a really important concept because we see it in a lot of fields. And one of the fields we see it in a lot of is investing. We have an index in the United States called the Russell 3000. It's an index of 3,000 large companies. This is how it's done over the last 38 years. It's done pretty well. It's an average annual return of about 10% per year. Pretty good return. If you look at how each of those individual 3,000 companies in the index has performed over these 38 years, you get some interesting information. You'll find that the median stock in this index underperformed the average by 54 percentage points. 40% of the companies in this index lost money over 38 years. A lot of those companies lost all of their value. They went out of business. 40% of the companies in the index did that. Virtually all of the gain of the index came from 7% of components that account for virtually all of the return. So here again, you start with something that has grown substantially over time, improved over time. And then you look at the nuance of what's going on inside, and it's chaos and loss and destruction. And now imagine if you were a parent, and you could see inside your child's brain every day, and see that every morning they were losing synaptic connections, and their brain was getting less complicated. You would panic, and you would say, this feels wrong, this doesn't feel right, I must be teaching my child wrong, my child's not getting smart anymore, even though it's actually a perfectly normal part of growth and development. As investors, we basically can do that same thing to our portfolio. Even when we have a diversified portfolio, say 20 or 50 or 100 companies, we're being bombarded with news about companies missing earnings, companies going out of business. And it can scare us and tempt us into making actions of saying, this is wrong, this doesn't feel right, I should do something about it, maybe sell these companies. Even though in reality, it's a perfectly normal part of how long-term growth in a diversified portfolio company works. And this also has a big impact on how we think about volatility as investors in the market. I just want to share with you some really interesting information that I've always found fascinating. From 1995 to 2015, the S&P 500 returned about 8% per year, pretty good return. The average US equity investor during this period, for returns that actually accrued to their brokerage account, was about 4.7% per year. So you have a period where the stock market does really well, and the average stock market investor earns almost half of that return. Why does that happen? Some of this is fees. That explains some of the difference, but that's only a small part of it. By far the bigger reason and explanation is that the average equity investor is buying and selling at the worst possible time. And you get this behavior that was depicted so well by Carl Richards of the New York Times, which is greed buy, fear sell, and repeat until broke. And why I think this happens is just how we think about volatility in general. This is the S&P 500 going back to 1950. This is a really good return. This is about as good as it gets for a large country. The market went up about 200-fold during this period if you include dividends. And this is as good as it gets. If we can repeat this over the next 60 years, that's as much as we could ever hope for. But this I want to show you, this is when the market is down 5% from its previous all-time high. That's when it's down 10% from its previous all-time high. And that's when it's down 20% or more from its previous all-time high. So you start with the picture of success, as good as it gets. And then you look at the nuance of what happened inside of that, and it's chaos and loss and destruction. And what's important is that at every one of these bars, you had investors all over the world saying, this doesn't feel right, this feels wrong, something is broken, so I want out, I'm going to sell. And they do it with good intentions. They think they're making themselves safer as investors, when in reality what they're very often doing is taking action that's going to pull themselves away from a long-term investing plan that's likely to work best. One of my favorite quotes is from Dwight Eisenhower, famous general and US president. Someone was asked him, what is the definition of a military genius? And Dwight Eisenhower said, quote, military genius is the man who can do the average thing when everyone else around him is losing his mind. And I've always thought it's the exact same for investing. Successful investing is not necessarily about making good decisions. It's about consistently avoiding mistakes, consistently not screwing up, and consistently not responding to short-term action that's likely to pull yourself away from a long-term plan that's likely to earn the highest returns. Third story I want to talk about today is what running teaches us about investing. About 100 years ago, there was a physiologist named Archibald Hill. And Archibald Hill was an absolute genius. He was one of the best physiologists of his day or even since. And he viewed the human body that he studied like it was a machine, like it was a car that was governed by pipes and pulleys and pistons that you could measure with precision. He once said, quote, our bodies are machines whose energy expenditures can be closely measured. And Hill was a great athlete himself. He was a big runner. And he devoted most of his career to answering the question, how fast can we run? Given my body, given my machine, given your machine, what's the fastest that we can run? What's the fastest, like how many horsepower do we have? He devised a series of experiments where he could bring an athlete into his laboratory and do a bunch of measurements on them. You'd measure things like how much oxygen they took in, how that oxygen was dispersed throughout their body, things like lactic acid buildup in their legs when they were running. And he came up with a set of formulas that could very accurately predict how fast that athlete could run. Someone would come into his office, they'd do the tests on him, and he could predict how fast that person could run 1 mile out on the test track. And these predictions were so accurate that Hill won the Nobel Prize in Medicine in 1922. And this caused a big buzz in the running community. Because if you can accurately predict how fast someone can run, you can predict who's going to win the next marathon or the next gold medal, which is a pretty big deal. But there's probably a reason that most of you have never heard of Archibald Hill, which is because those predictions, the ability to predict the next gold medalist, never happened. And it turned out there was an irony with Hill's research, which was that these predictions were very accurate in the laboratory and had almost no accuracy whatsoever on the racetrack. Someone once pointed this out to Hill, that his formulas had no use in predicting who was going to win the next race. And Hill said, quote, to tell you the truth, we don't do it because it's useful, we do it because it's amusing. Look, but this humility about why there was this gap between the lab and the racetrack caused Hill to really try to figure out why was this the case. And he spent the last half of his career trying to answer this question about why his predictions were of no use in predicting race winners. And he worked with a lot of other scientists to figure out why this was, and they eventually figured out what was going on, which is that during a competitive race where the stakes are very high, people get anxious, they get nervous, they get hyper-focused, all of which has a big impact on your athletic ability. And it is nearly impossible to replicate in the laboratory when the stakes aren't as high. If I tell you to go outside and run a mile as fast as you can right now, you might say, okay, you could do it in 8 minutes, let's say. You might say, that's the fastest I can run a mile. I gave it everything I had. I can run a mile in 8 minutes. But then if I say, okay, if you can do it in 7 minutes and 30 seconds, I'll give you $1 million, you'll find a way to do it. And how fast we can run is not just a function of our bodies. It's a function of our bodies within the context of the psychology of our in-the-moment circumstances. Hill, in an interesting coincidence, was married to John Maynard Keynes' sister. And Keynes discovered for whole economies what Hill discovered for people, which is that economies and athletes are not machines. They have souls. They have feelings and emotions. And because they have souls, they often perform in the real world vastly different than we would expect them to perform when we're studying them in the laboratory. Hill called this moral factors. Keynes called it animal spirits. both of it can just be summed up as there's a big difference between the laboratory and the test track, between the real world and the laboratory, excuse me. And Hill eventually came around on this. He changed his mind from saying that people are just machines to eventually saying, quote, there is clearly more than running to sheer chemistry. And I think that is also true about investing. There is so much evidence that there are all these factors and variables that we intuitively think should have a big impact on the market that end up not having as much impact on the market than we would think. A few years ago, a group of researchers from the Vanguard Group looked at a bunch of very popular market metrics and economic variables to see how those metrics correlated with what the market did over the subsequent 3 years. So what can we look at today, and how does that tell us what the market's going to do over the next 3 years? And these are those correlations. You have some things like the PE ratio that explain a decent amount of what's going to happen next in the market, but still a pretty small minority. And then you have all these other factors like profit growth, profit margins, interest rates, GDP growth, that literally have zero correlation to what the market is going to do next. You notice someone at Vanguard included rainfall as one of the variables that they tracked. And even rainfall has a higher correlation to what the market's going to do next than other things like corporate profit margins and GDP growth. They both tell you roughly nothing. And what this does to us as investors is it just makes it very difficult to predict what's going to happen next. You know, our stock market in the United States bottomed in March of 2009. And then it began to effectively go straight up from there. Big rally coming out of March 2009. By November of 2009, the market had gone up, I think, about 25% at that point. Barron's wrote an article. The headline of the article was, "The easy money has been made," which, of course, is a saying that just says anyone could have seen the rally coming up until now, but going forward, it's going to get much more difficult. 1 year later, 2010, the market kept rising. This time, Morningstar, they wrote an article called "The Easy Money Has Been Made." 1 year later, the market kept rising, kept going straight up. This time, MarketWatch, they say the easy money has been made. 2012, another big rally, market keeps going up. Street.com, they say the easy money's been made, folks. It's like 6 more of these. Keeps going. And look, the reason I point these out is not to poke fun, because these were written by very smart people. And if you read these articles, they make a lot of sense. They talked about stuff like our unemployment rate was very high. Economic growth was very low. The Fed was printing a ton of money. All these variables that you would think would prevent the market from continuing to rise. But they didn't, because there were other moral factors going on that were much more harder to measure. Things like people were scared in 2009, and they got a little more optimistic as the years went on. And that fact alone had a big impact on market valuations and PE ratios, which has been the major driver of returns over the last decade. But how do you measure what kind of mood people are in? How do you measure what the change in people's mood is going to be over time? Very difficult to do. You know, there's only 3 things that you need to know exactly what the stock market is going to do next. You only need to know the dividend yield, plus earnings growth, plus or minus the change in valuations. If you know those 3 things, you know exactly what any stock or stock market is going to do next. The dividend yield is pretty easy. We know what that number is today. Something like future earnings growth is a little bit more difficult, but we can make a reasonable guess about what it's going to be. The change in valuations is nearly impossible to know. Because what a change in valuations is a change in people's moods, change in people's feelings. When people are in a bad mood, valuations are low. When they're in a good mood, valuations are high. And how can I, as an analyst, trying to predict what the market's going to do over the next years, how could I possibly know what kind of mood people are going to be in 1 year from now? I don't know what kind of mood I'm going to be in tonight. And so this is why it's just very difficult to predict what's going to happen next in the market. And you know, this bothered me for a long time, because investing is a forward-looking endeavor. And how are we supposed to make decisions if we don't know what's going to happen next? I came across this quote from Benjamin Graham that I really love. He says, quote, "The purpose of the margin of safety is to render the forecast unnecessary." Margin of safety, or just room for error in what you're doing, makes forecasting effectively unnecessary. If you have room for error in your budgets, you don't need to know whether we're going to have a recession this year. You're not relying on that forecast. If you have room for error in your valuation analysis, you don't need to know whether we're going to have a bear market this year. You're not relying on that forecast. Room for error is, I think, the only way to navigate a world that is inherently difficult to predict. And I'll tell you something important about room for error. It is very often attributed with conservatism, not taking a lot of risk. I don't think that's right. What room for error does is it gives you and your clients the ability to endure future unknowns. And when you can endure future unknowns, you're giving yourself endurance. Compounding only works when you can give an asset years and years to grow. And the only way that you can survive as an investor during that time is if you have enough endurance to take on all the unpredictable nonsense that's going to happen between now and then. There are investors who don't use margin of safety, who might earn higher returns than you this year or next year, but they are much more likely to get wiped out or to give up when they come across something that they did not expect. And by giving yourself room for error, you're giving yourself a fighting chance to stick around for 10 or 20 or 30 years. That's when compounding works the best, and those are the investors who end up earning the highest returns. And the final story I want to talk about today is what the Wright brothers teach us about investing. Most of you recognize this picture. This is the first second of the first flight in human history, December 17th, 1903, in Kitty Hawk. It's hard to overstate how important this moment was because the airplane went on to change everything. It changed economies, changed transportation, completely revolutionized communication, started world wars, ended world wars, completely changed geopolitics. If you had to make a list of the most important inventions of the 20th century, I think the airplane would be at least top 3, if not number 1. And what's interesting about the airplane is that you didn't need any scientific knowledge to understand how amazing this was. There was a man flying through the sky for the first time. Even if you were a child, you were watching this in awe. And so you can imagine how big a deal this was at the time, and how people came together and said the world has changed forever. Nothing's ever going to be the same. How journalists came together and were writing about how big a deal this was and how exciting this was. Except that's not at all what happened. This is the New York Times from December 17th, 1903. It's small print, but you can take my word for it. There's not a single mention of the Wright brothers anywhere. The next day, December 18th, no mention anywhere. December 19th. By this time, they had flown 10 times. One of their flights lasted for 59 seconds, which was a long time for back then. No mention in the New York Times anywhere. The 20th, the 21st, the 22nd, no mention anywhere. This goes on for days, weeks, months, years. No mention about what the Wright brothers are doing. 2 years after the Wright brothers first flew, the New York Times did an interview with a German hot air balloon tycoon. And they asked the German hot air balloon tycoon if people would ever be able to fly in airplanes. They called it flying machine back then. They asked him if people would ever build an airplane. And he said, quote, "In the very, very, very far future, there may be flying machines, but not now, not now." This was 2 years after the Wright brothers first flew. And the largest newspaper in the United States still didn't even think we could do it. One of the most amazing things about the Wright brothers' story is that for years after they invented the airplane, no one paid attention. There was, in fact, one newspaper that covered the Wright brothers' first flight. It was the Dayton Herald. The Wright brothers were from Dayton, Ohio. And this is how they covered the first flight. "Dayton boys solve problem." Like it's a bunch of silly kids just doing a science experiment that didn't mean anything. The editor of this newspaper was asked years later why he was the only journalist who covered the story. The editor said, quote, "I used to chat with them, the Wright brothers, in a friendly way because I sort of felt sorry for them. They seemed like well-meaning, decent enough young men, and yet there they were wasting their time day after day on that ridiculous flying machine." So the only newspaper in the world that covered the Wright brothers' first flight did it out of sympathy for them. Now, after Kitty Hawk, the Wright brothers went back to Dayton, Ohio, where they were from. And this is where they really mastered flying. They mastered the two most difficult parts, which were turning and landing. And Dayton was a pretty populated town at the time. The Wright brothers were flying all over town, over people's homes. David McCullough wrote a great biography of the Wright brothers, and he talks about this period when they went back to Dayton. He writes, quote, "Not one reporter bothered to attend during this time, nor did public interest increase. With few exceptions, there seemed to be no interest at all, no local excitement or curiosity or sense of wonder over the miraculous thing happening right in Dayton's own backyard." Now, obviously, the Wright brothers eventually got the credit that they deserved, but it took about 5 years before anyone paid attention to them. And what's interesting is that there were a lot of engineering teams that were trying to build an airplane around this time. The Wright brothers were not the smartest. They definitely didn't have the most money. They weren't the best engineers. But most of the other teams gave up. And what the Wright brothers had that other people didn't was just an amazing amount of patience. And when we think of the traits of entrepreneurs, we often think of things like creativity, engineering ability. Rarely do we think about patience and time horizon as a competitive advantage. Or if we do, we often massively underestimate how much time is needed before the odds of success accrue in our favor. And that, of course, is also very true in investing. This is going back to the 1870s in the US stock market. What is the most you could have earned on an annual basis and the least you could have earned on an annual basis based on your holding period? If you held stocks for 1 year or 2 years or 5 years, what's the most and the least you earned on an annual basis throughout all the holding periods? And two things should be obvious from this chart. One is that it scales down perfectly over time. So stocks become less risky for the longer that you hold them for. The other thing that I think should stick out is that it's not until between 10 and 20 years that every period finishes with a positive return. Not a good return, just a positive return. I think we often have to be reminded that when progress is measured generationally, results should not be measured quarterly. The single biggest mistake that people make, especially with behavioral finance, is underestimating the amount of time that it's likely going to take for returns to accrue in your favor. If you ask most investors, are you a long-term investor? Most of them will tell you, yes, I'm a long-term investor. So everyone wants to be. But then if you ask them, what does long-term mean? What's the definition of long-term? Some of them might say 1 year, that's long-term. Some of them might say 3 years or 5 years, that's long-term. Some might tell you 10 years, that's a long time. We know historically a good definition of what long-term is between 10 or 20 years. That's just when every holding period has finished with a positive return. Now, if there is a common denominator in these 5 stories, it's that when we think about risk, we often think about what's going to happen to us. What is the market going to do to me? What is the economy going to do to me? I've often thought a much better way to think about risk is what do we do to ourselves? Our own biases, our own flaws, anchoring to our own history. And that can be disheartening for people to hear, that you're your own worst enemy in investing. I've often thought it's one of the most optimistic realizations, though, because you have no control over what the market's going to do next. You have no control over what the economy is going to do next. The only thing you have control over in investing is your own behaviors. And when you realize that the only thing you have control over is the most important aspect of investing, that's pretty optimistic. We're so lucky to live in an era where there are markets all over the world that are capable of generating big returns for ordinary people. And if we're not taking advantage of that, if we're not benefiting from that, it's often not because of what the markets did to us, it's because of what we did to ourselves. And we often have to be reminded that people do not get what they want or what they expect from markets. They get what they deserve. Thanks very much. Now, I don't know if this is telling that we have 6 chairs for 2 people. Do we have to sit far apart from each other?
All yours.
I'll sit right here.
We can. Thanks, Morgan.
Yeah.
Have seen this many times in the past on the YouTube video, and seeing it in live is a very different experience. I forgot the tablet. Sorry. If all of us and the world at large, which are your fans and who read your blog, start applying all that you say, what do we do for a living?
I don't think we're ever going to be able to solve for behavior. Because behavior, it's dealing with things that have been evolving for tens of millions of years. This is not just like trying to come up with a new formula. This is dopamine and serotonin. You're not, like, the idea that people can master that by reading a blog post, I think people's expectations should be much lower than that. So we're always going to have behavioral issues in the investing market. That's always going to be the case. I think we can get a little bit better around the edges, or if you can just become aware of your biases and where you're likely to go astray, you can get a little bit better. And I think what's important is that people just become more introspective about themselves and trying to understand their own goals and their own risk tolerance. But it's never something that we're going to be able to solve 100%. Daniel Kahneman, who is not only the current, but I think all-time foremost expert in behavioral biases, we asked him, has all this research made you, Dr. Kahneman, less biased? He said, no. He's as biased as he's ever been. So even if Daniel Kahneman can't overcome these flaws, I don't know how much hope that gives for the rest of us.
So Morgan, keeping that same context in mind, how do you apply your own learnings and experiences into your own investing? And I've read that you have a very, very simple framework of investing. And if that's true, I want to just highlight, yesterday after reading that, I realized that my investment is across multiple asset classes and 17 or 18 different securities and funds. And what I read about your investing style is it's present in just 4 investments.
Yeah.
And I want you to talk about it.
My whole net worth is a house, a checking account, Vanguard Total Stock Market Index, and now I own the Vanguard Total World Index. That's it. There's nothing else in there. I don't think it needs to be more complicated than that. And obviously those are very diversified funds, so it's not something that's that simple. You're still, basically what it is you're investing in capitalism. And you're just owning a slice of the global economy. And it's a bet on capitalism working over the next 30 or 40 years. And one of the reasons that I make my portfolio that simple is because the only metric that I want to think about is how can I increase the odds that I never have to sell the equities that I own. I'm never forced to sell them. And I think if you have fewer knobs to fiddle with in your portfolio, the less odds you have, the less opportunities you have to inject bias into your decision making. And since I'm just focused on the single variable of endurance, I also have a higher percentage of my assets in cash and bonds than most people my age would have. But again, like I talked about in the talk, I don't think that's conservatism. I don't think that's taking less risk. What I'm doing is I'm trying to ensure that the money that I do have invested in stocks can stay there forever. And I'm never going to get forced to a point where I have to sell stocks because there's some problem in my household, people lose their job, they get sick, all the issues that come across for everyone's life. I don't ever want to be forced into a situation where I have to sell the stocks that I have. And I think if I can remain true to that and leave them alone for 30 or 40 years, the odds that I'm going to be happy with the outcome at the end, I think, are pretty high.
So I think that's a very meditative way of saying that let me not bother about what's happening in the world and just focus on myself. And over the last many months and years in your own country, the narrative is about what's going to happen to the next election, what's going to happen to trade wars, interest rates at negative rates for a long period of time, the super debt cycle. So these are very nice, fashionable things which make us look like experts. How do you analyze these things, or you just don't bother about it?
Well, I read a lot about what's going on in the global economy, but they don't influence my investing decisions. I do it because what I like in investing and how I think about it is just the science of how people think about risk and opportunity and uncertainty, and just trying to get a better understanding of how people make decisions. And I think you can learn a lot of that by studying the global economy and a lot of other topics, politics and whatnot. But they don't necessarily influence my decisions. At some point, they might. Like, it's not just blind buy and hold, but I think it would take a lot for me to make a big change in my investment decisions. It would take a huge calamitous event for me to change my mind off of my current allocation.
So you said for you endurance matters a lot. What about quest for alpha? Does alpha matter to you?
I think, look, and this is where investing gets very personal. You just have to say, like, what is your goal? And my goal in investing is maximizing for how well I sleep at night. But that's very different from a hedge fund manager who's investing to maximize alpha this month. And I don't look down upon that. I don't think that's bad at all. But what works for one person is not going to work for someone else. So my investing plan, my allocation, I don't at all recommend that anyone else do that unless it works for you. If it doesn't work for you, then you need to find what works for yourself. I think a big problem in the investing industry is that we often take advice as stock advice that applies for everyone. That what is good advice for you is going to be good advice for you. And oftentimes if you're watching CNBC and someone says, you should sell this stock, I often say, well, who is you? Is this a 19-year-old investing for retirement, or is this a 78-year-old widow on a fixed income? It's a big difference between who's taking that advice. And we so rarely make that distinction when we're giving advice. So what works for me won't work for a lot of you. And what works for a lot of you won't work for me, and I think that's okay to accept that.
So I'm asking you a question again. You very clearly stated that a large part of your investment is in the index funds, the US fund and the global world fund. So you are in a way a proponent of passive investing, do you? And then I do recognize you again clarified saying all investing is personal. If you were to be asked the question, passive or active, again, I'm just saying, are you a believer that active investing does not generate excess returns?
Well, no, but I think I don't look down upon active investing in the slightest. I think there are a lot of very smart managers who will do very well over time. But we just need to grasp with both hands the statistics that we know about active investing, which is in the United States, it's different for other countries, but in the United States, about 90% of active funds will not beat their benchmarks over time. And I think if you accept that reality, then what we need to say about active is the people who do outperform over time will be rewarded very well. But the odds are not stacked in your favor in the slightest. And I think managers and investors should just accept that reality. What's interesting, though, is, of course, you're never going to meet an active manager who will even admit that they have trailed their benchmark in the past. You see the statistics, 90% have trailed their benchmark. I've never met one who will claim to have trailed their benchmark. Everyone will find some way to claim that they've outperformed. So I think it's a very important part of a healthy functioning market. And I certainly believe that, let's think about something like baseball. 99.9% of college baseball players will not go on to the big leagues. Does anyone say that you should not play college baseball because your chance of success is so low? No. They say, look, there's still value in doing that, but we just need to grab the reality of what the likely outcome is and accept it for what it is.
Very interesting question. How do you put equity investing in context if you're a Japanese investor?
Yeah, there's a meme, which is whenever anyone is talking about long-term investing and how it works over time, someone says, okay, now show Japan. And I think the explanation of Japan is, there's two explanations. One is that, look, over the last 30 years or thereabouts, the returns have been negative, terrible. The other side of that is that the returns for the 30 years before that were absolutely sensational. And that is often missed, that it's not just that returns were lost, but that they were heavily front-loaded into a 30-year period. So there's that aspect of it. And then the other aspect of it is, well, I don't think anyone would recommend that you put all of your money in Japanese equities. So to pick out the one country to which a long-term buy and hold approach has not worked at, I don't know if that discounts the viability of a diversified approach to long-term equity holding. Look, I'd also say, is there a possibility that if you own a global diversified portfolio of equities today, in index funds, 30 years from now, that will have lost a lot of money? Yes, I think the answer is absolutely yes, that's a possibility. It's a low possibility, but of course that's possible. There's another world war, or some huge calamitous event that we can't even fathom, of course it's a possibility. But I think it's a low enough possibility that it's worth the risk that you're taking. If a long-term buy and hold investor ever claims that they're not taking risk, I think they're being foolish about that. Of course, there's risk in everything.
So Morgan, it's extremely important to recognize these principles of buy and hold and discipline and stay invested for the long term. Having said that, the stimuli that investors keep getting are all about short-term stimuluses. So if you are an advisor facing clients and you recognize upfront that changing behavior is not easy, being more rational is very difficult, how would you attempt still, while you are doing it through your blogs, any practical approach? If you were an advisor, what are the 3 things you would tell?
I think there's really 2 things that I would focus on. The number one thing you can do as an advisor is to teach your clients about the history of volatility and how common volatility is. Because the most common reaction when there is a decline of 10 or 20% is this feeling of, this is wrong. This feels broken, like I just hit something that shouldn't have been there. When in reality, if you look at markets, very common to have big volatility. In the United States, over the last 100 years, there's been a 10% decline on average every 10 months. So when we have a 10% decline and people say, what is this, what's going on? The answer is, this has happened more than every year for the last century. About every 10 years, we have about a 30% decline. It's once a decade. Now, a lot of people have a time horizon that is greater than 10 years. Maybe it's 20, 30, even 40 years. Just as a normal par for the course, you should expect multiple 30% declines during that period in a normal market. But that's not how people usually think. And I think it's just because most people haven't seen the long-term history of how common volatility is. So I would rub that point in their faces. And the second thing I would do is try to get people more attuned to their past behavior, with the idea that your past behavior is going to be the best indication of your future behavior. And how you responded to the 2008 financial crisis or the 1999 bubble is likely a good indication of how you're likely to respond to those kind of events in the future. And so if you panicked in 2008, and many people did, I think you're likely to panic during the next big recession. And you should just embrace that as that's who you are and situate your asset allocation around that, rather than denying it or assuming that you learned your lesson, which you probably didn't, and thinking that you're not going to do it again next time. The history would show that most people who did it last time will do it next time.
I think it's a very big shift you're talking about, because the investing industry likes to show returns. What you're saying is show volatility first. Make people recognize volatility more than returns alone.
Yeah, well, I think the returns are often there for the taking. The global economy, if you're betting on capitalism, it's very likely going to generate a long-term return. It's there for you if you want it. And the question is, can you endure the obstacle course between now and then? And that's what volatility is. It's just it's the cost of admission. It's the price we have to pay to get that long-term reward. And if you're willing to pay that price, if you're willing to pay that cost of admission, pay the entrance fee, the theme park inside is pretty good. It's fun. So for most people, the price of admission is worth willing to pay. But oftentimes they pay it, and then they walk inside the theme park and they say, I don't like this, I want out, give me my money back. And so they walk out. But for people who can endure it over time, the results are generally pretty good.
Morgan, what would be your advice to institutional money managers who are trying to balance long-term goals that they can achieve by creating long-term value for their investors, but were measured on a short-term basis? And how do you balance and build a pragmatic approach to the same?
I have a lot of sympathy for institutional investors who want to do one thing and their investors do not let them. That's a really tough thing to deal with. And I know several professional money managers whose personal returns in their personal portfolios are far superior to their professional returns. Because in their professional returns, they're often being pushed around by their investors who give them a mandate or who won't put up with a certain kind of event. I remember in March of 2009 when the market bottomed on CNBC, one of the anchors interviewed a money manager, or a group of money managers, and every one of the money managers said, we think this is the bottom. And then the anchor said, so what are you guys doing with your portfolio? And they said, we're all in cash. He said, I don't get it. You think this is the bottom, but you're all in cash. Why? And they said, because our clients won't put up with another down month. So that's a really difficult thing to do. If there's any way to get around that, and this is a very difficult answer, but I think it's the only practical answer, is that the best investors that I know, to a T, without exception, are picky about their clients. And they will turn down money if they don't think their client's vision will align with theirs. And that's a hard thing to do, particularly with big money. If a client comes to you and says, I want to give you $100 million, you're going to say no to that? Give up all the fees on that money? That's hard to do. But every successful investor I know does that. And a lot of them that I've met will fire clients. If they have a client that's calling them up saying, why do we have a down month? They'll say, thank you, sir, here's your money back. We're clearly not a good fit for you. That's very difficult to do, but that's always the common denominator.
There was a very interesting slide which said that most variables that we look for in our decision making have very poor predictive power in terms of getting a sense on future returns. In that context, if you have to ever look at rebalancing your portfolios or tweaking your asset allocation once in a while, what factor would you give respect to?
I think if I was going to do that, and I don't rebalance, but I might at some point, but if I was going to do that, I would just make it systematic and say I'm going to rebalance once a year or once a quarter, whatever it is. And I think if you make it systematic, you're just you're removing bias from the equation. Once you start saying, I'm going to rebalance, once it meets this metric that I made up, well, you're not always going to be biased. There's smart people who can do that, but you're increasing the odds of injecting bias into that decision-making process. And so I just personally want to avoid all of that. So to the extent that I do or would increase activity in my asset allocation, I would try to systematize it as much as I could.
And how do you stay away from this strong desire of activity, apart from writing? And
I think a lot of it is just personality based. And look, I'm making these numbers up, but I've always thought that 10% of people don't need any investing help. They just get it. They intuitively, naturally get it. Another 10% of people can never be helped. They're compulsive gamblers. No matter what you tell them, they're always going to be drawn to poor decisions. And then there's another 80% of people that I think want and need good advice. But inherent in that is that there's 10% of people that I think are always going to be drawn towards day trading, towards trying to reach for the big return that's this week or next month. And I think that's just personality based. So it's no issue for me whatsoever to ignore that. I think for probably most people in this room, they could ignore that as well. But there's a decent chunk of society that can't.
One bias that you would want to eliminate personally, if you could?
I think something I think a lot about for myself, this is true for almost everyone, is people they kind of live in the bubble of their own country. And when I think about how markets work, you see on all the slides today, I use US markets for everything. That's just because I was born in America. Why am I not looking at Japan or Germany or Switzerland markets? It's just because I happen to be born in America for no other reason. So I think taking a more global view about what has happened to other countries, happened to other societies. This is especially true in the United States because we've had a pretty good 60-year run since the end of World War II. We've become a big, powerful country. And it gives a lot of us this idea that we're invincible, that nothing bad can happen to us. And I think that's a very dangerous point of view. And I think we have to be able to look at what's happened to Venezuela or Zimbabwe or something and say, if it could happen there, it could happen here. I don't think it's going to happen here. I hope not. But if it happens somewhere else, of course it could happen to you. So taking more of a global view and not being attached to your homeland is, I think, a bias that I struggle with, and I think a lot of people do.
There are lots of stories and narratives experts give. How do you evaluate them? How do you take a call that these are just narratives and not necessarily value adding? How do you filter through that?
I think narratives and stories is just a way to contextualize information. And if you're just given bland information, just data or a chart, like it might be useful, but it's only going to be really practical to you if you can really put it in the context of your own life. And I think the best way to do that is to kind of frame a story behind it of how this has impacted other people. And of course, virtually every one of those stories is an anecdote. And you have to be careful about not taking an anecdote and assuming it's a trend. That's the hard part about stories. But stories are amazingly powerful at contextualizing the data and making it relevant to your real life versus just a number sitting on the page.
My last question, one life and investing advice to yourself if you were 20. You look 20 though.
Thank you. I think. If I was 20, what would I say? I mean, I basically started investing when I was 20. And I made every mistake that there was to make. I started out day trading, lost a lot of money. And then I moved on to holding stocks for a couple months and lost a lot of money. And then I was a stock picker and lost some money. So I just learned my way through it like everyone else. And I don't regret that because the learning process was valuable. But if I could go back to when I was 20, I would change almost everything about what I did. And I would pick all the stocks that went up.
Please put them in your blog.
I'll try.
When you do that.
If we go back in time.
Thank you very much.
Thank you. I have one more thing. I've taken a lot of pictures today, so I'm going to return it, the selfie.
Can I
Okay, wave everybody.
How can I join this?
You want to come in?
Yes.
Come on in.